Hey friends, Lucian here with the Bullish Bears team. This video is going to be about the most popular day trading indicators. So I want to talk about indicators in general. They are very helpful to determine major support and resistance levels when you're day trading or any type of trading, whether you're a swing trader or long-term trader. While they are helpful, they can also be overwhelming if you use too many indicators. So you could have indicator overload. So if you're new to trading or just day trading in general, don't bog yourself down with all the different indicators because it could be, again, overwhelming trying to find the best indicators. Because overall, it's important to remember these indicators are lagging and there are no foolproof indicators, right? So there isn't a magic indicator out there that's going to be a magic fix. There's nothing that's going to tell you exactly 100% what a stock is going to do. Again, even the best traders in the world fail on trades, especially as day traders, 30 to 40% of the time. So there are no foolproof indicators. There are some that are helpful, but again, nothing is 100% foolproof. Now, by far, the most important indicator that you can use when trading is candlesticks. Now, if you're new to trading, you could be like, wow, there's a lot of different patterns out there. Man, that's the best way to learn how to trade. Yes, trading takes time. Like I said, there is no perfect indicator, and learning patterns is going to be the most important indicator that you can use when day trading or trading in general. Now, candlesticks, there are a lot of different patterns that are out there, but they form based upon the battle from the bulls and the bears. So whenever the bulls and the bears are duking it out, each day they form patterns, and those patterns form very important support and resistance levels. All the other indicators that are out there, they form from the basis of price action, which is candlesticks. So candlesticks form those important support and resistance levels, and all the other indicators basically come from price action. So learning price action or candlesticks is the most important line of defense when trading. Now, if you need more help with learning candlesticks, you can download our free candlesticks ebook over on our website or under our courses section. We also include our desktop wallpaper backgrounds as well. Here's an example of just one of our custom desktop backgrounds. These are great. It shows you entries and stop loss levels. This is just our bullish patterns one. We also have a bearish patterns and reversals one as well. So make sure you download these, put them on your computer. It just, again, takes a while to learn these patterns. So, the subliminal, like seeing this on your computer each day will help you to kind of remember, as, times go along when you're looking at other charts. If you're like, hey, what kind of pattern is that? You can quickly glance over at our wallpaper background. So having these, again, available on your computer or printing them out, they're a very helpful resource when you're learning trading. So if you're brand new, again, keep this in the background. Don't bog yourself down totally with candlesticks. You have to learn the concept of what you're doing first. And then again, practice along the way by studying the different patterns, looking at different charts, look at our ebook, look at the wallpapers, and kind of get confirmation of what these patterns are. They're not going to be foolproof. Some will look better than others, but don't bog yourself down trying to say, hey, wait a second, is that a bull flag or is it a pennant? Again, many a times something will tell the same story, but it doesn't have to be exact or precise. So after candlesticks, I'd say volume is one of the next most important indicators. So basically, whatever traders around the world buy and sell shares of a stock, this creates volume. Now, volume is important on all time frames, such as the daily, 5-minute, 1-minute, weekly, and monthly charts. Whatever time frame you're trading on, again, volume tells a very important story overall. So the higher the volume, the higher the liquidity. This basically means it's easier to get in and out of a stock. If a stock doesn't have much volume, it's going to get harder to get in and out of that particular stock. Now, a stock like Apple or Facebook or Netflix or Google, you're not going to have a problem with liquidity. But if you get into those little low float stocks, if they don't have a lot of volume, the spreads can be crazy, and that's where you can get yourself in a jam. if you don't have enough volume. Also, volume confirms breakouts and breakdowns. So if you get a breakout or a breakdown with volume spikes, that helps to confirm what's actually happening. If you get a breakout or a breakdown and there's not a lot of volume, again, sometimes it could be a false breakout. Now here's an example of what volume looks like on a chart. Any platform that you use, you can just add the volume bars, and you'll see a lot of times, huge candlesticks. It doesn't always happen this way, but you'll see many times big sell-offs or big candlesticks on the way up near huge volume spikes. So you'll see on this chart here, I kind of highlighted some selling pressure on the left one. Then on the right one, you can see big volume spike to the bullish side. And then also the last one there again, big volume coming in, pushing price up. Again, this will happen a lot near support resistance levels, near breakout levels of, those moving average lines, which I will talk about. But kind of putting that whole everything together, these indicators, while nothing's foolproof, it helps to kind of, when you get the candlesticks, the volume, with other things like moving average lines, which I'll explain, kind of helps to tell you a better support, story of overall support and resistance levels, which gives you the clues on where to potentially enter and exit a trade. So now let's talk about moving average lines. There are a couple there's basically two types that are the most popular. There's exponential moving average lines, or EMAs, and simple moving average lines, otherwise known as SMAs. Now they show very important support and resistance levels on charts. EMAs are more of the quicker time frame, so they react quicker to price changes, where simple moving average lines, they're a little bit slower, but both are very popular on all time frames. So let's talk about some of the most popular ones. You'll see my chart here has some EMAs and SMAs. You'll see to the top left, you'll see a breakdown of what I have on my chart. Again, everybody has their own preferences, but here's some of the most popular, and then you can tweak them based upon your own preferences as well. So I have the 9 EMA, or exponential moving average, and the 20 exponential moving average. If you use the 9 and the 20, there are other people that will use the 13 EMA. So, it's a matter of your preference. The 13 is somewhat in between the 9 and the 20. So if you use the 9 and the 20 exponential moving average on your charts, you don't really need to use the 13. If you use the 13 EMA, you don't need to use the 9 and the 20. Also very popular ones are the 50 and the 200 simple moving average lines, or SMA. So the 50 and the 200 SMA, very popular. And also too, another one that's popular is the 100 simple moving average. So as far as simple moving average lines goes, the 50, the 100, the 200, very popular. And then as far as EMAs, either the 9 and the 20 together, or the 13 EMA, whatever your preference is. Now again, it's important to remember, moving average lines, they're lagging indicators, they're not foolproof, but they show very important support and resistance levels. So if you're looking for support and resistance, it shows, when candlesticks move up to those or down to those levels, if price can't hold on either side of it, it tells, again, very important support and resistance levels. VWAP, otherwise known as volume weighted average price, is another important intraday indicator, and traders use this to manage their entries and exits. It averages the closing prices of a security's intraday price or intraday price action, and it's used as a guide for support and resistance levels. Just to put it in plain English, it's the average price of the stock throughout the trading day. You'll see here a chart of Apple on a 5-minute, that yellow line. Again, you can change the color however you'd like it. But on this chart, you'll see the VWAP for the day is on that yellow. So it shows other days as well, previous days, but pay attention from October 26th as I'm making this video. You'll see that line intraday. That's the average price throughout the trading day. Next up, let's talk about relative strength index, or RSI. Just kind of picture stocks like rubber bands, right? They want to snap back, or you'll hear the term pullback, to support and resistance levels the more that they become overbought and oversold. So if a stock is overbought, it's overextended to the upside. If a stock is oversold, it means it's getting buried and it's on the downside. So whenever you get those two extremes, stocks become like rubber bands and they kind of want to move back to those equilibrium levels. Now, this can happen over time or it can happen very quickly depending on what, again, it can happen on a low float stock as well as a stock like Apple. So pay attention to the extremes, both to the upside and the downside, and then watch price, how it naturally wants to gravitate back to those, many a times those moving average lines. So again, while moving average lines are not foolproof by any means, you'll see those extremes at RSI levels where price will want to move back towards those moving average lines. So another popular indicator people use in place of RSI is Bollinger Bands. So RSI is a kind of a study you can add on to your chart, whereas Bollinger Bands gives you more of a visual. They tell the same story. Again, it's just a matter of your preference. So take a look at this chart of Apple here. It's a weekly chart. You'll see on the bottom I added the study RSI, or Relative Strength Index, and you'll see kind of I highlighted those overbought and oversold levels. And you'll see if you look above, up near the candlesticks, where the candlesticks are, you can see where there's extremes, right? When price is far away from those moving average lines, it kind of wants to gravitate back, right? So you'll see overbought, and when it got oversold, you'll see price as it got oversold, it started to move back to those moving average lines. And so the farther away, you can see, you don't even necessarily need RSI on your charts. You can see as price goes far away from those moving average lines, it naturally wants to pull back to them. With a lower float stock, it might happen a lot quicker, like boom, pump and dump right back down. Whereas a stock like Apple, it might gravitate back on, slower. It can happen very volatile as well, but typically in the larger caps, you'll see it. Maybe it happens over a course of a few days or a few weeks, depending on what chart time frame you're looking at. Fibonacci retracement, it's also another popular indicator that's used, and it shows how deep a pullback or a retracement might be. So you connect peaks and valleys on a chart, and it determines the levels of support and resistance on multiple time frames. So you can see on a chart here, like on Apple, here's just a 5-minute chart. You'll see I connected the base, or the support, or the low level on the day with the high, and I connected from the bottom up to the top, and then you'll see kind of how price reacts throughout the day. So as it fell down, again, you can do this on all different time frames, daily, weekly, monthly, hourly charts, whatever your time preference is. But you'll see just kind of from this example, as price started to move back up, you'll see a lot of times it'll go above a resistance level. It'll come back and it'll consolidate before it continues up. It'll kind of consolidate again before it continues up. And a lot of times price will get a lot more volatile. The candlesticks will get a lot more volatile as price broaches these levels. And you'll see right there that big candlestick happened right at that 38% level, where it smacked up, hit resistance, and then it kind of pulled back a little bit at the end of the day. So again, these Fibonacci retracement levels show very important support and resistance levels. Level 2 with time and sales is also another popular indicator. Level 2 is a tool that's used by traders to see the different bid and ask spreads and shows where the buyers and sellers are. It's a handy indicator which helps gauge on when you should take a possible trade or, exit a trade. Time and sales data tells you the volume, price, and direction, along with the date and time of real-time orders. Now you got to be careful, like with any indicators, again, it can get over analysis paralysis, but level 2 is very helpful if you're trading those, like low flow or penny stocks. But also be aware too, it can be manipulated. So it's not foolproof. Again, no indicator is foolproof, but it is a helpful guide. Time and sales gives you the actual orders that are coming through, whereas level 2 can be played around with the computers. Time and sales shows you the actual order flow that's coming through, and that can't be manipulated. Now, here's an example of DOS Trader. Again, everybody's levels 2. All the brokers have different level 2 and time and sales, but you'll see the different bid ask buyers and sellers to the left, and you'll see to the right the order flow coming through on all the different exchanges. So again, there's a lot of different day trading indicators that are out there. These are some of the most popular ones. Again, it's so important. Price action and candlesticks along with volume, those are the most important ones. But learning how to create, and draw support and resistance levels and trend lines, that all comes from candlesticks. So once you learn candlesticks, you can learn the most important support and resistance levels. That's where you can connect your trend lines and your horizontal support and resistance levels. And again, with indicators, they can be overwhelming. You don't want to bog yourself down. The most important thing to realize is they're a helpful guide, but nothing is foolproof when it comes to trading. It would be nice if there was an indicator that'll tell you 100% that you're going to win on every trade, but that's not realistic. Again, with trading, even the best traders in the world, they fail 30 to 40% of the time, and that's why you have to be able to manage your risk properly. Keep your losses small, let your winners outweigh your losses. Have ideally at least a minimum of a 1 to 2 risk reward ratio, ideally 1 to 3 or 4. So if you're risking $1 on a trade, you want the ability to at least make $2. If you're risking, 10 cents, you want to have the ability to at least make 20 cents, or ideally 30 to 40 cents. So this way, when you have the proper risk parameters set up, again, you use along the way when you're learning how to trade, you kind of put everything together. You use these, indicators and everything as a guide. But once you're tracking, you want to make sure, again, you're tracking all of your trades. Make sure that your winners outweigh your losses. And again, just use these indicators as a helpful guide, not as a crutch. So hopefully this video on day trading indicators helped you, and we will see you in our community. Enjoy.